Hi, my name is Mike Tusaw. I'm a financial advisor from St. Charles Wealth Management. Today, we're going to talk about determining the right level of leverage for you as a trader and or an investor. Now, in my career, I've been in the business around 20 years, and I would estimate that I've had over 10,000 conversations with people one-on-one. And I'm not talking about group conversations, I'm talking about one-on-one conversations with people. And so within those conversations, one thing that I've found is that the number one reason for people having problems in the derivative world, the options, I should say, is the fact that they over leverage themselves. Oftentimes, people put more money in than they should. And when they do that, when a trade goes against them or the investment doesn't pan out how they think it will, they just get sickened by the idea and never come back. And that's very unfortunate. Now, I want to emphasize that risk management and leverage control are two different concepts. Risk management means that at what point are you wrong on a trade? That's when you get out of the trade, and you can manage risk in a lot of different ways, which we talk about on other videos. But leverage is totally different. Meaning, if you say, okay, I'm going to buy all sorts of these out of the money calls and I'm going to buy 10,000 of them, I don't care how well you manage your leverage. If 10,000 calls is more than you can afford to lose, even if the calls go to zero, then you're over leveraging yourself. And I know this is a little bit of an extreme example, but I just want to have it help you to have an understanding that determining the right level of leverage for you as a trader and or an investor is very important. Now, let's start off with an example that I like to use when I feel like I'm not putting enough money into a trade or into an investment or whatever the case may be. If you take $1,000 and you double it 10 times, that'll be $1 million. Now, of course, that's not factoring in taxes or commissions or things like that. I'm just saying if $1,000 doubles 10 times, then you will have $1 million. And what I mean by that is 1,000 gets you two, two gets you four, and so on. So if you're ever within a trading or investing system and you're thinking, I should really put more money into this, well, it may or may not be a good idea, because if you have good compound interest, which Einstein said was one of the most powerful forces in the universe, you'll have the ability to make money. You just need to be patient with it. And by not putting too much in, you avoid a lot of problems. Let's start by talking about levels of leverage. For example, let's say that you were normally going to buy 100 shares of stock. And instead of buying 100 shares of stock, you decide to just buy one 99 Delta call option and keep the rest of the money in cash. Well, if you were to do that, that would be no leverage whatsoever, because you would actually have this pretty much the same level of risk as you would by owning the stock. But instead, all you have is the call option and the risk of what the call option is. Now, of course, I wouldn't advise buying such a high delta call option, because there's bid-ask spread, liquidity risk, and there's some other risks that are involved with it. But for purpose of determining your level of leverage, that's one way with which to look at it. Now, let's say that you were to buy two at-the-money calls that are both a 50 delta. By doing that, that's also not having any leverage at all, because of the fact that you're going to have 100 deltas, which is the same as 100 shares of stock. Now, as the market goes higher, that delta can change and you can create leverage, or the market can go against you. And by doing that, you'll have less deltas. The point is that if you look at the position delta, you can determine how many shares of stock you own. Now, let's say you buy 4 at-the-money call options. Well, then you're going to have 200 deltas. And if with the same amount of money you would normally buy that 100 shares of stock with, then you're leveraging yourself a little bit. Now, what level is best for you is a question that only you and your financial advisor can determine. But typically, what I like to do is, if I'm being extremely speculative, I usually don't go any more than 3 or 4 to 1 if I'm looking to be or if I'm looking to leverage myself with a long premium trade. So even then, that's even on the high end, but it's something to think about if you're looking to leverage yourself. Now let's talk about leveraging yourself with short premium. How does this work? Well, first off, the way with which you would not have any leverage would be if you're selling premium in a covered call or a cash secured put. For example, if you own 100 shares of stock and you sell a covered call against it, there's no leverage involved whatsoever with that. You're just simply collecting income and allowing yourself to be called away and sell the stock if called upon to do so. By the same token, let's say that a stock is trading at 50 and you were to sell the 50 strike put against it, and you have all $5,000 in the account and you're fine owning the stock at that level without any margin or anything like that. That's also a way with which you can sell premium and not have any leverage involved whatsoever. Now, how can leverage be involved? Well, a couple of ways. Let's say that you buy stock on margin and sell covered calls against all of it. That's one way. Or if you just want to sell naked puts, then that means that in the example that I just gave, normally you'd have $5,000 in your account to sell a cash secured put at the 50 level. Well, maybe you only have $2,000 or $3,000 in your account. And then if the stock does get put to you, you're buying the stock on margin. I'll be honest with you, I really seldom, if ever, do this. And the reason is that if I'm selling premium, I don't want to get into trouble with leverage. So I really think it's just not a good idea, quite frankly. The only times I'll do it is if maybe we don't have the cash settlement and the cash is going to be in the account the next day or something like that. And even then, I'm very wary about it. If you are going to leverage yourself by selling premium, I would highly recommend considering spreads, vertical spreads, which we'll talk about in another video. That way, you know that you have a defined risk and a defined reward. So you know that you can't lose any more than what's already in your account when doing so. If you enjoyed today's video, please subscribe. That's how we get our content out to more people. If you're looking for a financial advisor who works with options and typically doesn't leverage, but does occasionally, feel free to reach out to me. You can check out my website, stcharleswealth.com, or you can follow me on Twitter at Mike Tusaw. Thank you and have a wonderful day.